So we have jobs getting revised down, but wages are getting revised up.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
Welcome to the Friday edition of the Daily Dots. Here on Friday, the 1st of August, Chase rolling solo with you to wrap up the week. And a big wrap up it is. The topic really of the day is about the stagflationary backdrop we find ourselves in all of a sudden. And I'll touch on all that. I'll hit on the markets and then talk about the very, very impactful data, not to mention the impactful reaction to it today. Things are definitely getting a little interesting all of a sudden after kind of a very quiet few weeks. The S&P closed the day down 1.6%, the Qs down 2%, small caps down 2%, equal weight down 1.13, Mag 7 down 3.17, all world ex-US down 0.33. So nice, at least one day comeback for non-US equities. The dollar down 1.37%. Bitcoin was down about 2%. You're now under 114,000. Crude oil down 3%. Now nearly under $67 after touching 70. Gold ended the day up 2%. A very nice showing from gold. Silver up 1%. Most of the other metals up a little bit as well. As far as the market goes, probably the big story here, the 2-year yield down 28 basis points. So more than one entire cut for the next 2 years priced into the 2-year, with the 10-year down 16 basis points and the 30-year down 8. Somewhat notable that the 30-year held that firm against, what the front end did. But we'll see. As far as vol, you had a 10.5% jump in front month vol. So you're back up almost to 20. You were there at one point during the day. So pretty significant pop in vol. And very importantly, it looks like by my math, negative dealers will probably have been pushed into negative gamma. So we start next week with the possibility of a good bit more volatility, bigger moves. Doesn't have to be down. Get the right good news, it could be up, but bigger moves than we've gotten used to here lately. So that'll be something to kind of keep an eye on. Obviously, the big news of the day was the jobs report, which we talked about yesterday. And I'd mentioned even that, hey, like some good modeling from people like Bloomberg Economics was showing it looked like it would beat to the upside. Then you had ADP beat to the upside, but then jobs did not beat to the upside. The actual jobs print for this month, honestly, not that bad. Not that big a deal. But the revisions were atrocious. You took basically 250,000 jobs out of the last 2 months, the prior 2 months, through revisions. So, we've had a lot of revisions the last few years. Just that the way they're counting the jobs with birth death model, things like that, it is definitely flawed. So they end up doing a lot of cleanup along the way. And I've been able to largely ignore that, and knew that, we're going to revise some jobs out, but it's not going to hit the economy. But to see that many that fast here lately, that was definitely concerning. And on top of that, if you look at kind of the more cyclical stuff, as far as thinking about business cycle, you had manufacturing jobs expected to be flat, and we're down 11,000. And then construction jobs were negative again, and I think that's four months in a row, 5 of the last 6 months that construction jobs have been negative now. And that's something anyone that's been listening to us for more than, a year knows. I've just been beating on that drum for like 2 years that, hey, watch construction employment. All the leading indicators suggest this should be a problem. And in the past, construction employment losses have led to other kinds of demand losses, which led to other construction job losses. It's sort of a keystone in the business cycle. So it is concerning, but at the same time, we're like 3,000 jobs off the high, and you're talking almost 1 million construction jobs. So you're 0.3 percent off the highs. So yes, we're starting to contract in construction work, but it's very, very small. It's similar with manufacturing. If you look at a zoomed out chart of manufacturing jobs, gains and losses over history, yes, we're starting to lose them. But again, like you zoom out, you lost so much more. Around '08, obviously, but even around the year 2000, we've had some manufacturing recessions between 2010 and 2020 that were worse than this. So, like, yes, manufacturing looks like a problem, and for some real reasons that I'll talk about a little bit. But at the same time, like, you're not there yet. Like, this still feels like a slow down, not like a break or a big problem. We do still have positive hiring, considering what's going on with immigration. Printing kind of 50 to 100, 150, like all that's fine as long as you're kind of above that 50. Roughly, you're probably above replacement. Now that you're not doing a bunch of net positive immigration, and that kind of shows in the unemployment rate. Like, this was a bad report, and you're still only 4.2% unemployment rate. Like, it's very, very low historically, which shows like the labor force is shrinking at the same time that the jobs market is. So they're in some sense sort of netting each other out. Now, for GDP purposes, for growth, like, having less people is a problem to begin with, because just the number of people is part of the equation of GDP. But you know, having jobs weaken this way is kind of it is a problem for growth potentially. But I do think it's worth noting, like, if you look at the aggregate payrolls, which is it combines obviously the number of jobs, but also hours and wages, it's fine. Like, there's nothing to worry about if you look at that chart. You're like, oh, okay, well, the labor market's definitely weakened here, but like it's healthy, it's okay, and that is still literally true. Obviously, more worrying after this print, but if you just kind of back away and look at the market, the job market, you're like, all right, yeah, like, things aren't as good as they were, but they still, like, nothing looks like, oh man, recession's imminent. Like, this thing is broken. It might be starting to break, but it has not broken. And more to that point, like, of the wage component, despite these bad numbers, wages came in hot, like hotter than expected, hotter than last month, and last month was revised higher. So we have jobs getting revised down, but wages are getting revised up. And obviously, to me, it's obvious the reason behind that is immigration. Like, you have less people competing for the same amount of jobs. I mentioned yesterday, the Dallas Fed said, hey, like, we're seeing this in Texas. Like, you're starting to get more hours and more pay, and that stuff's getting sticky. I said, hey, wage growth is getting important. So if you look at average hourly earnings, I think it's 3.9% year over year. And if you take the entire 2007 to 2020, that whole 13, 14 years period, you were never that high on average hourly earnings. That whole over a decade, basically a decade and a half. And yet we just might be bottoming there right now. Just similar to like the Cleveland Fed 16% trim mean inflation thing I talked about, I think, yesterday. You're bottoming before you even got to the peak of the old range. This is very inflationary stuff to me. Like, wages bottoming at really high levels is not good for inflation. If you look at the Atlanta Fed wage tracker, which is to me like the best wage tracker out there, 4.2% and starting to move up. If you look at the employment cost index, which I mentioned yesterday, Fed's like, go to, higher than expected yesterday. You're running at 0.9% quarter over quarter for 3 quarters in a row. Again, if you take that 07 to 2020 range, you're above that. You haven't even gotten back to the peaks of that whole range. So basically, any wage data you want to look at, that's 3 different measures: average hourly earnings, the Atlanta Fed's wage tracker, and the employment cost index. All 3 of those looked like they're bottoming above the entire 07 to 2020 range. Like, you didn't even get to the peaks of that range. So clearly, you're getting an inflation impulse from the labor market all of a sudden, which is kind of where the stagflation part comes from. Like, growth clearly kind of a problem. Like, housing, obviously struggling. Manufacturing, obviously struggling. We had ISM came in today as well, below expectations. It was supposed to go up, and instead it went down. The employment metric in that has only been lower during the COVID recession in '08. Other than that, you haven't been lower if you go back to like '05. Like, so take it back 20 years. The only times you've been worse off were in those two recessions. So it looks like employment and manufacturing is bad. And this, it kind of goes into what at least my thesis on this, that tariffs at the end of the day create problems for manufacturers, because call it a fourth, somewhere between a fourth and half of our imports of goods are either raw materials or intermediate goods, both used as pure inputs into our own manufacturing process. If you make the cost of those things go up, call it 10, 20, 30%, with tariffs, like the pressure that puts on those producers, margins and profitability, not to mention, all the uncertainty around the policy where it can make them freeze up. Like, they're going to have to let go of some people. Now, they only let go of 11,000 people, it looks like, this month. Nothing crazy, but hey, economists expected zero. So to see some, job losses in manufacturing, whenever you have that thesis in the back of your head of how tariffs could hurt them, it just feels significant to me. And then as I've already outlined, like, we do see the inflation coming through. So if you look at things we import a lot from China, say, like that inflation is absolutely inflecting higher. So goods inflation is really picking up. Wage inflation looks like it might be bottoming and picking back up. Now rates fell a lot today. That might actually help housing stabilize. And if rates fall enough on the 10-year, like that will help housing stabilize a lot. You can get prices picked back up positive, things like that, which in a lot of ways is good for the economy. But in some ways, like, maybe we should celebrate this getting better. Same with wages. Like, yeah, wage growth makes inflation, and that's bad for a lot of things. But at the same time, it's not bad for the people getting the wage gains, right?
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
The other thing I wanted to talk about, there was sort of a ramification of today, and that is the president is saying he will fire the head of the BLS, who's responsible for the jobs report data. Obviously, you get the May and June data, and the White House celebrates it, takes it out on a roadshow, and tells everyone how great the jobs data is. They didn't have a problem with the data then, and now we get a bad print and we fire the person. This is very, very concerning to me. Now, the person has not literally been fired yet, so let's hold on. Like, maybe they ended up not getting fired or whatever. But I do worry about political pressure on the statistics coming out of the country as like a future problem. If they start telling you there's no inflation and that growth's great, and both aren't true, that sends that is more destructive than I could find the words to explain. It's a very like banana republic kind of move to make. And the last thing you want is your leadership not having the real picture of what's going on, much less, the markets. We have to stay as a country in the good opinion of capital markets. And that's the kind of thing that where you do not stay in the good opinion of capital markets. The capital goes where it's treated best. It definitely doesn't like to go where it's lied to. So I'm hoping that cooler heads prevail on that. And it turns more into a like, hey, let's make the quality of the data a little better, because you can definitely fairly poke at their data collection quality, their data analysis quality. Whenever you have to do 250,000 revisions over the last 2 months, like, there's something broken, right? That's kind of obvious. There's always gonna be revisions. You're always gonna get more and better data as you move along for the past, where you can rectify it. Like, oh yeah, we had that a little bit off with our survey data. Totally fine. Like, that makes sense. But intellectually, you can just kind of pick apart things like the birth death model, understand they broke in COVID. Maybe we should unbreak them. Like, I'm okay with something like that. I'm not okay with like, hey, politically, I need good data, so go make good data. I don't tell us it's bad. Like, that's very, old school, like Soviet stuff, or like North Korean type stuff. Like, there's no room for that in the US. So hopefully we don't go down that road. But if we do, that becomes a very problematic thing for capital. I think a lot of capital would want out on that. I mean, it should at least. Maybe it doesn't mean it will, but so that's a concern moving forward. And hey, if that were to actually play out, and I'll call it low probability, high impact for now, then we have to find like really good proxies to start tracking this kind of data to figure out what the truth is and how it deviates from official data, which we could absolutely do. We have plenty of tools in order to find some good proxies, and I'm sure other people would do that as well pretty quickly. But hopefully, it doesn't come to that because, for obvious reasons, that wouldn't be good. Stagflation is a term that, like, first of all, I'll define it. It means growth bad, inflation high. Most of the time, it's not a thing. Really, before we had it in the 70s, there were people that didn't think it was even possible, really. And a lot of pop economists and pop market experts love to throw the word around and say it's coming all the time, my entire career. It's usually not. It is rare. I've probably called a false dawn on stagflation myself in the past if I went back and looked. But it is definitely something that's overused, emphasized all too often. I bet if you put in like a headline search for the last 25 years of warnings of it, you'd have it pretty much every year. But this current mix that we're seeing in the data, it really is stagflationary. And at the end of the day, I think tariffs just by themselves are stagflationary. Like, obviously, it makes the price of things go up. Like, literally, it does that. Now, that doesn't mean the entirety of CPI has to go up, because as I've discussed before, like, hey, maybe services goes down so much it offsets it. Totally possible. I'm open to that. I don't think it's the way it'll play out, but I'm open to it. So prices have to go up on goods that are imported just naturally. But then, like, that production process part, that's what I worry about is you have, you gum up our own making of things because of all the imported inputs into our own processes. Now, manufacturing still is a pretty small part of the economy. So this also has to go and touch into services, which it does. Like, if you look at all the tech giants, like, they're going to have to pay tariffs. They're going to have more. It's going to be more expensive to build a data center. It's going to be more expensive to power it. All these things, and part of it obviously because tariffs, like steel, aluminum, copper. Although we kind of partially waved the white flag on copper this week. If the price of those things go up, and then the price of industrial machinery goes up, and just basic things, screws and bolts and whatever, like tools and like everything gets a little more expensive that touches that. And then people want higher wages because they have more bills to pay, and then those wages in themselves kind of become inflationary, and then inflation expectations pick up. And so, like, that's why I think you are actually going into like a relatively high inflation environment. Basically, everything I look at, other than current housing deflation, suggests like we're in trouble on an inflation standpoint. Now, I guess you could run it hot. We need to. Eventually, we're going to do that, whether we want to or not. The problem short term is, even though voters more or less vote for inflation, they hate it. If you look at pretty much any kind of polling on like what people are most concerned about, it's inflation. So I guess you could run inflation at 5% and then tell everyone it's 2 or whatever, but like, they're going to know. I mean, we kind of just went through that in 2021, 2022. Everyone's like, oh, it's transitory. It's not even that big a deal. But voters are like, well, it's a big deal to me. You're fired. So we could get back into that kind of thing where, yes, the White House wants lower rates and cuts and stuff. But at the same time, if inflation's 3 to 4, in that range, call it 2.5 to 4.5 or something, I think people are probably still not very happy about inflation. And this is with currently gasoline being cheap, some of the headline stuff being cheap. If that reverses, and it might, if we really do actually go after Russia here in the next week or two, like on their commodity exports, inflation becomes like a significant political issue. We have midterms coming up. It's just hard to imagine such a purposeful inflation igniting policy leading into every period is politically, like rot in America, I guess, but it's going to be politically important, from here in late 25 into 26, obviously. So it's going to be interesting to see how it's played out. I think our recession odds just like are huge right now. I still don't. I think the jobs market can hang in a little longer, a little better than people expect. But I am very concerned when I look at things like construction and manufacturing. If they don't hold up and that begins to spread over to services, and we know, you know, consumption has been coming down a lot. Like the last few quarters, like just down more every quarter. So that may be pressuring services to a degree already. If jobs were to become a feedback loop on demand, then the demand problem becomes a job problem too, and then yeah, okay, well you are going to go into a recession. But I think a recession requires a really significant pullback in asset prices. Obviously, we're down a little bit now off the peak, but I think you need to be down over 20% from the highs and stay that way for a few months. We're nowhere near that. I think you have to have that to really get a recession, just because if rich people are rich and they're still feeling rich and they're still spending money, it can do a lot to keep the rest of the economy afloat, even if a bigger percentage of the population is hurting. And I think that is probably true every month. I'm not sure we're going to go into a recession very quickly with all the stimulus we do have, whether mostly from the deficit. Obviously, we have significant support from that. But one thing, I'll leave it with this for wrap up for the week. But one thing I find interesting is that you get the feeling the White House, President Trump thinks, all we got to do is cut rates, and then all this will be fine. I wrote a whole piece August of 2024 about this, to outline like why I don't think rate cuts even help. Not very many people get to refi into a new rate the way, for my whole life, every time we cut rates, it was to a new lower level and everyone got to refi. Talking trillions of dollars of effective stimulus. And people got to borrow and expand businesses and everything at great new rates, right? Well, now, like, even if we cut rates, we're not cutting them to negative, which means we're not going to put in a lower low, which means we're not going to have trillions and trillions of essential refining and rolling over of debt. Even if the Fed starts cutting 50 basis points per meeting, like it takes a while before anyone can even refi into a better rate, because we came from zero. So all that like 3 to 5 year old money that's just super common when it comes to credit, that's rolling over. Even if we do cut rates a couple more times, like they're probably still rolling over in a higher rate. Same for the national debt. Like there's going to be a lot of debt maturing that has to roll into a higher rate, even if we're cutting rates. So expecting some big, massive boost from cutting rates, I'm not seeing it. Now, will it help? If the 10-year yield comes down, will it help real estate? Yes, absolutely. And that is definitely not nothing. But I'm not even convinced cutting up the front end hard is going to make the 10-year rally a ton. Will it rally early on because it fears a recession? Sure. But if we avoid a recession, it has to go back up because inflation's higher. And if we don't avoid a recession and we have one, the deficit probably blows out to 12% of GDP. And then my assumption would be some bond buyers would look at that and go, I don't really want to own this if the deficit's going to be that high and we know we're going to print the rest. Like, it feels like a better place to put your money than a bond at that point. Just my view, and not to mention, cutting interest rates literally starves the private sector economy of the interest income. Maybe good for the government's balance sheet, bad for private sector balance sheet. And if that's allowed to occur while the private sector balance sheet has some other problems, potential problems, that could be big. And if, let's say, housing for whatever reason isn't going to recover from here from a price standpoint, let's say we stay flat to maybe down a little, year over year, call it like let's say at some point we have a 2-year look back and like, ooh, national housing is actually below where it was 2 years ago, which doesn't feel super likely, but possible. That's the kind of an area where like all of a sudden people stop feeling so rich. Like that home value is off the highs, not only in like price, but in duration by a little bit. Like, man, this has been like, off the high for 2 years. Now there's a lot of work left to do that for now. Like most people's homes aren't down for 1 year. But that would start messing with the wealth effect a little bit, where if like stocks pulled back too, like, people are not feeling as rich. And then they would probably not spend nearly as much. Um, that mixed with tariffs and immigration keeping wages high, like it is a stagflationary mix to me. I hate to kind of go out and use the phrase because everyone overuses it, like I mentioned, but I'm struggling to see where a lot of disinflation comes from, and I'm struggling to see where a big pickup in cyclical sectors and growth comes from. Now, AI could just make us so productive that growth is good, even if manufacturing, construction, and all that kind of stuff's terrible. Like I'm open to that. That's possible, but I don't think that's a responsible base case, though. I guess. But I'll leave you with all that. Next week's gonna be interesting. Like I said, probably going to Monday negative gamma. So if there's bad news over the weekend, or people digest this and decide they got to sell some stuff, or people that didn't sell today because they're on vacation come back in and sell Monday, you could end up in a situation where you get vol going from 19 to 30 in a week or something. So it's definitely a head on the swivel week next week, as everyone's on vacation to begin with, and we may have a bit of a pullback. Although, like, you look at the S&P chart, it's just totally normal if we have like a 7% pullback. That's not even bearish. Like it honestly needs it. We had on the monthly chart, you can see there was a level we just kept fighting for like 3 or 4 months, and then we blasted through it. I think a retest of that level definitely on the cards. To me, as long as the backdrop doesn't erode further, I think you would probably just be better served to just buy that retest of that level. It made sense to like get a little cautious going into this, which thankfully we were able to do with at least more cash. But I think deploying some of it on that retest there would probably make sense, unless the backdrop had changed and gotten uglier in some way. But that's it for this week. Don't forget, you can download and subscribe at knowyourriskpodcast.com. We'll see you next week. Have a great weekend. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.